happen yet. It'll have sometimes you just get worse and worse and worse, and this one it got better and better and better. No, but this tree just got better.
Yeah. So you're taking the numbers from here to there. So that's how much we'll be paying. The difference between March 2016 and current.
Well, current is here, and you just notch up each interval. That's how much they pay.
So that will be the
How about that?
Okay, we have a lot to get through, and we know you're anxious to hear, and we want to get started. I'm Joni Cameron Pritchett. I'm your current president of the York University Staff Association. I want to do really quick introductions. To my right, Giulio Malfatti is your first vice president, and Robin Smith is the second vice president. And I just want to flag for you, Robin has to step out and attend another meeting, so she's going to be scooting off in about soon-ish. So I just wanted to flag that. I also want to let you know we are webcasting this, so that folks that don't have an opportunity to be here in person because they're either at Glendon or at one of our satellites or off-campus locations, or they're not able to leave their office or have accessibility issues. So the cameras are primarily pointed here, but of course if you ask a question at the mic, you may be on camera, and we would ask that you use the mics for questions so that we can hear you. The primary speaker for us today and educator on this topic is Darrell Brown. And I was remiss in the first meeting by not just giving a little brief overview. Darrell works at Sack Goldblatt Mitchell, one of the biggest law firms, labor law firms. Is that fair to say? Pretty fair to say? Okay. But Darrell's been instrumental working with the York University All Unions group on this matter. He's a leading expert on pensions for sure. We've been really lucky to have him guide us through this process because it has been definitely daunting at times. And he's absolutely been a brilliant resource for us, and we've been lucky to have him. He has been advising the union group only. I want to clarify that because I think there might have been some confusion. He's not advising the university, just the unions through this process, and we couldn't have done it without him. So we will be taking questions from you at the end. Without any further ado, I want Darrell to come up and get started, and we're really grateful to have him. Thanks.
Thanks for those kind words, but of course we don't want to underestimate the role that Giulio's played in the YUPG, and Joni and Giulio on the Board of Trustees over the longer term in terms of what happens with the York University Pension Plan. I'm going to speak probably fairly quickly, maybe faster than the first session because we're a bit late in getting started, but I want to give you a little bit of background again in terms of how we got to where we are now, as well as talk about what the Memorandum of Agreement actually entails. And that really means talking about the funded status of the University Pension Plan, what the Solvency Relief process is. That's a government-mandated process. It's not mandatory, but it's certainly desirable for pension plans to participate in it that are underfunded. What the York University Pension Group is and what principles drove our negotiations. Not going to go through the whole iteration of what proposals were forwarded from each side, but I will draw you to what the university proposed in May after receipt of what we consider to be our proposal from YUPG. What we got back in terms of concessions from the university, which I think is a very good story. So we'll talk about the terms of the Memorandum of Agreement, and then we'll open the floor to questions. So without further ado, on to some fairly complex material, but I don't know how much each of you are aware of in terms of how a pension plan works, but when there is a defined benefit component of a pension plan, and your minimum guarantee is a defined benefit, you are guaranteed a certain level of income under that benefit, aside from what you can earn in your money purchase account. There's requirements under the Pension Benefits Act that you do that the plan sponsor perform actuarial valuations, and they're done on two different bases. One is called a going concern valuation. A going concern valuation assumes that your plan's going to go on forever, which is a good assumption. And it's a good assumption because it allows you to then make economic and demographic assumptions that look at the longer term. And, normally we're going to look at about a 40-year time horizon at least. And so you're not affected by, let's say, a 2007, 2008 market crash as much as you might be affected with another type of valuation. So under the going concern assumptions, we're looking at, based on the 2012, December 31, 2012 valuation of the plan, a deficit of $220 million in the York University pension plan. Now, the other valuation is called a solvency valuation. And what that assumes is that at December 31, 2012, the plan stopped, it terminated. And what a solvency valuation requires you to do is make your economic assumptions based on the current market conditions. So, for example, if you were doing a valuation in 2009 after the crash, it wouldn't have been a very good story in terms of the assumptions. It also wasn't a very good story for subsequent years because the interest rates were low. And when interest rates are low, your projection of your liabilities goes up because you have to have more money allocated to earn the same amount. And so for the solvency valuations, for most plans, you saw a significant increase in the projection of liabilities over what we'd seen in past years. Now, based on the last valuation available, it's $350 million, or it's actually 354, I think, to be exact, as a solvency deficit. Now, going concern projections are less volatile year over year, and it's the one that you should be concerned about as a plan member because it speaks to the affordability of the plan. Solvency valuations can fluctuate widely and put what some would consider unrealistic special contribution requirements in addition to what the university would normally contribute to your money purchase account. They'd also have to put other money in called special payments to fund those deficits. Now, looking at going concern, basically what we're saying is you've earned benefits, but those benefits have not been fully paid for. And there are a number of ways that problem can be solved, either jointly or exclusively. I mean, if you can try and wait it out and see whether investment returns are going to be sufficiently healthy to make up the deficit over a longer term, you could ask for members to contribute more, or the university, or both to contribute more. Or the employer takes more money out of the operating budget and pays those special payments to reduce the deficit. If we look at solvency relief as a program, after the crash of 2008, the vast majority, I'd say maybe 85 to 90% of pension plans that had a defined benefit component were in deficit. That meant that their pension benefits were not fully funded, and they needed to make, pursuant to the Pension Benefits Act regulations, they would have to make special payments in addition to what their regular contribution would be to the pension plan. So the government introduced a solvency relief process that was framed to be in 2 stages. And York University wanted to take advantage of this for obvious reasons, because the first stage was a 3-year period where they wouldn't have to make any of those special payments to fund that solvency deficit. Normally, what would happen is if you had that $350 million of liability as a solvency deficit, the university would have to pay that out in 5 years. And so you can just calculate the numbers. It's a significant drain on the operating budget of the university. So by participating in the Solvency Relief Program, they would not have to pay those special payments, only interest on what those payments would be for that 3-year period. But they had to do something in exchange for that. They had to propose or present a plan that would lead to some savings and reduce the deficit. And the government provided a formula for how to calculate a savings target, which basically meant taking the last 4 filed valuations, doing an average, and calculating what a savings target would be, and it turned out to be 5.1% of earned benefits. So that's the savings target that plan amendments would have to achieve. And to qualify for Phase 2, one must demonstrate substantial progress in achieving the savings target. Now, just so you have an idea of the timeline, we're doing, or the university is doing, an actuarial evaluation at the end of this year. That would really have to embody what these changes would be, although they don't have to be implemented. There'd have to be agreement on what the changes would be. They would then file a stage 2 report to the government, and the government would look at this and say, have they made substantial progress or not? If they make substantial progress, then what phase 2 means is that you get to amortize that deficit, the solvency deficit, over 10 years instead of 5. And if any other deficit comes up on the solvency side, it's included in that 10-year amortization. So it makes a significant difference in terms of how much money has to come out of the operating budget of the university to fund that solvency deficit. So, moving on to the York University Pension Group, it's comprised of all of the unions at the university. And the obvious rationale for forming this group was strength in numbers in terms of negotiating with the university on what changes might be proposed. Also, the York University Faculty Association is the only union that has a veto in their collective agreement over plan amendments to the York University pension plan. So if all of the unions joined together with YUFA, and YUFA had agreed to work in concert with the other unions, then if we present one face, the university is at a substantial disadvantage because we had a mechanism to reject a proposal that we did not like if the university were to present something that seemed untoward. And to give you an idea, the 7 unions comprise about 80% of the membership in the York University pension plan, so it's a substantial representation. We established a number of principles within the pension group, and these principles were that there should be no changes to the benefits of retirees. We should continue to have a hybrid plan. Now, your plan has 2 components. You have a minimum guarantee, that's a defined benefit. You also have what's called a money purchase account, which is what's defined contribution. The money purchase account is the university contributes to that account, you contribute to that account, it's all your money. And the question at retirement is that money purchase account worth more than the value of the minimum guarantee? If it's worth more, you retire on the money purchase account, and you receive your monthly pension benefits calculated on the basis of the value of that account. If it's worth less, the minimum guarantee kicks in and you get that as your monthly benefit. So we looked at maintaining the hybrid plan. We didn't want, we wanted the changes to be consistent with long-term plan affordability. We did not want to see any changes to accrued benefits, and by the way, it would be illegal to reduce accrued benefits anyway under the Pension Benefits Act. We wanted to maintain the current benefit structure, meaning maintain the minimum guarantee, even if there would be increased contribution requirements to maintain that. And one of the other things that we had in our initial principles, which ultimately backed off from for good reason, and I'll explain why later, is that we wanted a sunset clause where we would, once the plan came to a surplus, revisit whether the amendments that were made should be reversed. But ultimately, we did not put in a sunset clause, and for good reason. Okay, so after a prolonged period, we spent 2 years at this really in terms of developing our proposals, doing analysis, and then having discussions with the university over time. We wanted to deal with the solvency relief aspect as stage 1 of our negotiation process, and then stage 2 deal with a whole series of other issues that come up with the administration of the pension plan and other pension plan amendments that might be desirable. That second part is not part of this presentation today because we're still engaging in the process of defining what we want to do with that second part. We're looking only at an agreement to enable the solvency relief. That's what we're talking about now. So the university proposed an increase of 6.75% of your earnings up to the year's maximum pensionable earnings. Now, the year's maximum pensionable earnings is the amount that is covered under the Canada Pension Plan, okay? And above that, 9.15% would be your earnings contribution rate above the YMPE. So the university wanted that to be effective January 1, 2014. Also, the university matches your contributions to the money purchase account, and under the current plan terms contributes an additional 3% to fund what's called the non-reduction reserve. And I'm not going to get into an explanation now because of time as to what that non-reduction reserve is, but the proposal was to eliminate that 3%. And they proposed also moving the basis for inflation adjustment to a 6-year moving average, where currently it's a 4-year moving average, and then also a proviso that if the above changes weren't enough, we'd have to come back to the table quickly to address any government concerns that might be raised. Well, this next slide I call YUPG achievements, because I think we made significant gains above and beyond what the university was proposing as the baseline. First of all, we agreed, actually we had proposed that contribution increase. It was our figures that went to the university that they adopted. But we wanted it phased in over 5-6-month intervals so that there would be time for you to absorb the impact of increased contributions, and also time for there to be increases in earnings to offset the increased contribution levels. We didn't go to a 5-year inflation adjustment mechanism for the moving average. We went, 6-year rather, we went to a 5-year, with the recognition that if we didn't meet the savings target, we might have to go to 6, but we wanted to move to 5 rather than automatically go to 6. There's another area that was of concern basically from an administration standpoint, and that was that under the current practice, prior to retirement, the moving average was calculated using the fund returns, where really the inflation adjustment should be calculated from retirement onward, and we wanted everybody to be treated equally in terms of how the moving average baseline was set. So now, that 5-year moving average, which is currently 4-year, prior to retirement is just deemed to be set at the 6% level, which is the level that's used as the baseline to determine your inflation adjustments. The way it works now, prior to the changes, is once you retire, each year you take you look back for 4 years over what the fund return has been, and you calculate an average. If that average is above 6%, you subtract whatever the return was. Let's say it was 7% on average, minus 6%, that's 1%. So your pension would be adjusted for that year by that 1%, okay? We just use the baseline of 6% now before, under these proposals, before you retire, so that everybody is treated the same. Because what happened in the past is there would be some people cherry picking. They were made aware of what the calculations would be. They would retire in December to capture what was the return level, where they knew if it was done in January, there would be a lower moving average used. Now it's just going to be 6% prior to retirement, and then you start with your calculations based on the fund return after your retirement. It looks like I'm now running on reserve battery power, so we might end up losing the screen in a minute. I thought we were plugged in, but perhaps not. In any event, I hope we don't lose the screen. Okay. A key change, and I think this is a fundamental gain on the part of the YUPG, is that we now have a protocol established that the university has to present to the All-University Pension Committee any plan amendment, any change in actuarial assumptions, any change in administrative practices, cost it, explain the rationale for it, and provide an opportunity for the AUPC to respond to it and perhaps provide a counter proposal prior to its implementation. One of the serious issues that we've had in the past is that we had no control over how the plan was being administered. There was really no transparency, and if there were problems, we didn't know exactly how some things were being calculated, for example. There's now a mechanism to address those issues, and one of the issues in the past, for example, has been actuarial assumptions that were inappropriate. Now we have a tool to address what might be done on an inappropriate basis or an appropriate basis, but we at least have a mechanism that requires transparency and requires the university to give an opportunity to your representatives to counter-propose. The other thing that's incorporated into this agreement is as you may be aware, there were contribution holidays taken from 1985 through to 2001 by the university. They amounted to about $79 million, and not factoring in investment returns. A large portion of that, roughly around 49 million of those contribution holidays, related to university contributions to your money purchase account. So they use surplus from the plan to pay their contribution obligation to your money purchase. Now, having said that, by the way, given the funded status of the plan from 2002 onward, they pretty much have paid all of that money taken in contribution holidays back into the plan. So I think it's a wash on that side. But what's critical is part of this memorandum of agreement, they are now prohibited from taking contribution holidays related to your money purchase account, university contributions into the future. So I think that is a significant gain, and what you need to understand is the current court approach in terms of jurisprudence is that if there's nothing prohibiting somebody from taking a contribution holiday under a plan, they can do it. You don't need positive language saying that you can do it. So basically, the university was in a position where if the plan did come into surplus, they could take a contribution holiday, whereas under this memorandum of agreement, they're going to be blocked, at least as it relates to the money purchase account. And then we've got a commitment to discuss in phase 2 all of our concerns on other matters that relate to administration and non-cost changes to the plan. So there's a mechanism in place to move forward. Now, I don't want to get into too much detail on this, but I want you to understand how things have shifted. Based on the memorandum of agreement, we believe we've achieved the 5.1% savings target, although there could be some machinations based on what the valuation actually produces at the end of the year, because it's a moving target. However, if we look at the first column, you can see this is the present value of future benefits under the plan for active members. So there's it's broken down by contributions. So if you look at the money purchase account line, you can see that without a higher contribution, this is the amount that would be that you've got in the money purchase accounts, and then you've got future member contributions and future employer contributions. That employer contribution is slightly higher than the member contribution because of that 3% to the non-reduction reserve. But then you see the funding requirement for the minimum guarantee, and it's at roughly about $480 million. With the higher contributions that we propose now, there's a shift. You see the money going to your money purchase account instead. Your contributions plus the employer contributions. But there's a reduction on the part of the funding that's required of the university to fund the minimum guarantee. Why is that? It's because in future it's likely that more people will retire on their money purchase account instead of on the minimum guarantee. Right now, because of what's happened with the crash in 2008 and the lower fund returns, about 95% of people are retiring on the minimum guarantee. It used to be the case that nearly all people were retiring on their money purchase accounts. With higher contributions, the likelihood is over time that will shift back. Then that reduces those extra contributions that the university would have to make to fund the minimum guarantee. So it's an exchange of money as to where it's going, but we then see a savings of roughly about $78.3 million, which is just about the amount that would achieve a 5.1% savings target that the government wants to see. But I want you also to be aware that, what are the consequences if we were to say, we don't like this agreement and we're not going to take care to engage in solvency relief. The plan is placed in jeopardy in terms of what the level of contributions would be from the university. But I think there's also political ramifications. There's been talk of universities joining the college's jointly sponsored pension plan, which has vastly higher contribution requirements than what are proposed under this memorandum of agreement. The government has stated as its goal that it wants to see a 50-50 contribution target, meaning that the university and the employees would contribute the same amounts. When I say that the university and yourselves are contributing the same amount to your money purchase account, you have to factor in that. On top of that, then the university funds the defined benefit guarantee. They pay substantially more on an aggregate basis than the members do, year over year. And so if we were to move to what the government would like to see, you would see your contribution rates go much higher than what's being proposed here. And also, in a jointly sponsored pension plan model, and by the way, the Ontario Council of Universities is developing a proposal for a jointly sponsored plan model, and ACUFA's, the Council of University Faculty Associations, is developing a counter-proposal. But just so that you're aware, in the JSPP environment, you can reduce benefits if there's a funding problem. You can't do that under your plan here. So, and then you have the specter of a provincial election, and if anybody has been listening to what Mr. Hudak's opinion is of broader public sector and public sector pensions, he wants to see everybody in a defined contribution arrangement where there's no guarantees. So you also have to think about these ramifications as you consider what the Memorandum of Agreement does. So let's look at a few questions that's been posed in other meetings with other unions, and one of them is, how much will I have to pay each month? It's a natural question to ask. How will the increased contributions affect my pension income? One question posed, with long-term bond rates going up, the deficit is going to come down in this valuation. So one person asked, well, let's say the deficit comes down by 50%. Why should we increase contribution rates at all? So I'll deal with that question. And then there's one, do we still have to make higher contributions if the plan comes into a surplus? And then how does this compare to other university plans? On the website, you'll have a table that shows you by salary band what the annual contributions will be, both currently and through the phase-in of the increased contributions. Now, I've assumed increases in the YMPE for 2014, 2015, 2016 of a 2% increase per year. That may or may not happen. If the YMPE is lower, you would have slightly larger contributions because your contribution rate up to the YMPE is lower than above. But in any event, you'll be able to check based on your own salary what the projected amounts would be required, but I'm not going to go through the list now. The whole presentation will be on the website. In terms of effect on pension income, this is something that you should be aware of. For long service employees that are close to retirement, the increased contributions aren't likely to benefit you very much because most people right now are retiring on the defined benefit, the minimum guarantee. And if you retire on the minimum guarantee, you're going to get that formula. So you'll be contributing more. But one way of thinking about this is that the contribution rates that you've been paying for years is not adequate to fund the benefits that you're actually promised. And if you look at going back to 1989 when the Income Tax Act was changed, they assumed that to meet let's say a plan that's close to what you'd be provided in terms of benefits, that you'd probably need about 18% of compensation as a contribution basis. So let's say 9% for you, 9% for the employer if it's being split. And that was in an environment where there was much higher returns. We're in an environment where there's much lower returns right now, and you'd probably need more than that. So when you look at what the split in the contribution is now of 4.5% and 6%, it doesn't come close to that kind of projection. So the thought is, you have earned benefits that have been promised, but the contribution rates that were specified under the plan for years really were not adequate to fund what you've already earned. The situation isn't the same for younger members because with a higher contribution rates, the likelihood is that the money purchase balances are going to go up and they're going to eventually exceed the minimum benefit guarantee, and people will retire using their money purchase balance and not the minimum guarantee. So there is a differential effect depending on your age and your service, and you can do projections using the retirement planner to see what that effect might be. But I do want you to understand that there are some options to mitigate against this. First of all, recognize that the increased contributions is increasing the affordability of this plan over the long term. It's increasing the health of the plan. And it's funding the existing benefits that you've already been promised. But for members who work past 65, and I understand that there's a few in the YUSA group, you can opt to cease contributing to your money purchase account. And then you can shift that contribution over to a voluntary account. And if you do that, then you're not going to be paying into the money purchase account when you are likely going to retire on the minimum guarantee, and you'll earn money on the voluntary side. So that's one way to mitigate against the effect that I'm talking about for some of the older plan members. Now, on that question of why don't we wait and see what the investment returns produce, well, recognize that without higher contributions, we still have a going concern funding deficit that's going to stick around for quite some time. And we are still faced with that problem of the future volatility of the solvency valuations having an ongoing impact on the ability of the university to deal with their operations. If we have stage 2 solvency relief granted, based on what the memorandum of agreement provides, then you've got that 10-year window going from the end of 2014 onward. And if there's any downturn that another deficit kicks in, that deficit also applies to the 10-year extension. So if we didn't make changes before the end of the year, there's no basis to demonstrate that we meet the savings target, then the university would have to contribute over 5 years to rid itself of the solvency deficit. And if that was the requirement, even if you divide by half that $350 million, is still a huge impact on the operational budget of the university. And indirectly, I would think a huge impact on what then is extended to you as staff. So there's, we would estimate that if you were looking at a 50% drop, there would be an increased drain on the university budget of 2% of its operational budget next year. So it's quite important that we be able to demonstrate that we have an agreement that achieves the saving target and allows for the extended period in phase 2. So I've already really spoken about the cut in half by year-end 2013 and approximately 2% of the budget. So we wouldn't want to not respond in some way to have the Ministry of Finance grant that phase 2 relief. Why no sunset clause? This is an important point. When we first were thinking about what would be our proposal, it made sense to think that we should have a sunset clause that once the university hits surplus, that all of these changes are reversed. But then step back and think about it. What have we achieved? We've achieved the university agreeing to increase their contribution in the same amount as your increased contribution to your money purchase account. Their contribution and your contribution are your money. So it's, to our mind, a benefit to have that increased contribution continue after the plan is in a healthy funding position, because it becomes your money, both the university side and yours, and there's potential for you to have a higher retirement income than would otherwise be the case. It doesn't make sense to have that automatically reversed. And I emphasize again that the university is now prohibited from taking contribution holidays to fund the money purchase contribution, so there won't be that deleterious effect on the funded status of the plan. The university has to take from their operating budget to contribute to your money purchase account, as well as you paying the increased level, as I outlined previously. So how does this compare to other university plans? I think the comparator that makes most sense is Queen's University, that has a very similar hybrid plan. If we look at the contributions scenario under Queen's, you can see that the members contribute more under the changes that they've adopted than the university. What we achieved is a requirement that the university contribute the exact same in terms of increased contributions as you will be contributing. So there's a significant difference there. The employer contribution to the non-reduction guarantee was eliminated at Queens. It's eliminated here. However, we retained indexing of the defined benefit minimum guarantee. So when you retire, you are going to have the right to have your benefit indexed based on the, if you were receiving a minimum guarantee. Queens eliminated it. The indexing averaging period, Queens went from 4 to 6. We've gone from 4 to 5. The longer the period, arguably the less frequent your inflation adjustments. And our minimum guarantee formula is slightly higher than Queens. I'm not going to talk about the normal form right now, but they have a life guaranteed for 10 years for everybody. We have different normal forms of pension, depending on whether you're married or single, and that might be an issue that's discussed in the future. We certainly discussed it as part of our process of negotiating and the proposals developed by the YUPG, but we thought that was better left for maybe stage 2 discussions rather than the solvency relief. Just to give you an idea of who was at the table in terms of the YUPG, you can see that Joni and Julio were there in the thick of it with YUSA, and the other representatives are identified from the various unions, and there was a fair bit of technical expertise relied upon. Anthony Benjamin from Eckler was doing our actuarial projections, and then we had input also from CUPE's national and regional offices. So now I open the floor to your questions. I know it's kind of a heavy topic, and it's a lot to take in, but I'll do my best to answer your concerns. And please use the mics.
Jane Grant. For those of us who have to make a decision about retirement within the next year or so, could you please specify on what date the adoption of this 5-year rolling average takes place, assuming that the vote is positive?
2014? I think it's 2014. I think the intent is that it's going to be January 1, 2014 for the moving average adjustment. The only thing that's staggered is the contribution side of this. I think the other concessions, like the 3% elimination, the non-reduction reserve, and the moving average is intended to be implemented January 1, 2014.
No, it's 15.
No? 15? Up, I'm sorry. January 1, 15. 15. Good that we have more eyes than me.
Okay.
January 1, 15.
Nick Velasquez. I see that we have not fully recovered from the crash of 2008, and the effects will certainly be with us for many, many more years to come. And because I see also outside influence, outside of our union and the agreement between our union and our university by governments and corporations, to do many disturbing things, like, for example, raiding pension funds, taking over our pension savings in our bank accounts, many of these disturbing trends. What assurances do we have, or what measures can we take as employees, taxpayers, voters, consumers, to try to prevent another crash of 2008 happening again and putting us in the hole? Do we have any say or any control over our future?
That's a loaded question. Good, Joni will come first.
I'll try and tackle that. I think one of the positives that came out of this experience was the opportunity for all the unions, the YUPG that is up here on the screen, to come together, because you can appreciate amongst those unions, there's quite a diverse group, right? And needs are different, salaries are certainly different, so impact could be perceived differently for sure. So that gave our internal community within our union construct to come together and really find where we can get the best benefit for all of us. How can we demonstrate our solidarity within the unions of York University and pull together and really mobilize and find the best possible solution for everyone, not just for a few, not just for the faculty or the higher paid employees, but for the entire group of all union groups. So I think that opportunity that came through this experience allowed us to really pull together and mobilize. So I think the solidarity within our community has never been stronger. Certainly we had lots of colorful debates in the room amongst the unions, but through that I think there was a lot of opportunities for learning about each other, what's important, what our needs and interests are, and how we can help each other get to the best resolution.
I think our greatest threat to our pension plan will come from external, specifically the provincial government. Not only is there the discussion about forming all of the universities into one pension plan, there's discussions about all of the universities joining OMERS, which is the Ontario Municipal Employees Group, or joining teachers, forming another giant pension fund. Okay? But that creates other problems, and I think Darrell will allude to those, where we won't have control over what our benefits will be. Okay? And of course, you have the Conservative provincial government, Conservative provincial party. If they form a government, they've already stated that they want to turn all of the defined benefit plans, the public sector defined benefit plans, into defined contributions, which is nothing more than a glorified RSP. So our greatest threat is external. Internal, as Joni was saying, we're very united, and since there's only one pension plan at York, everyone at York has the same concerns. Okay.
I think we've had a very one-sided argument in public about public sector and broader public sector pension plans, because there's another side of the story, and people are being fed the line that you have these golden plated pensions, and that why should you do so much better than people in the private sector, and that the level playing field should be one where your pensions are reduced. But the counter-argument to that is that there are significant, broad economic benefits to having pension plans that provide adequate retirement income. And they can be quantified and amply demonstrated as to what the plus side is, which is never discussed when you hear a Mr. Hudak talking about pensions, nor is it discussed when you hear Mr. Flaherty talking about his pooled program. So, I think part of this effort is education in terms of what these types of plans and what an enhanced CPP, for example, means to the economy. Because actually, when you do the calculations and you see what the impact is overall, both on what would otherwise be, the social costs of treating people in old age, and also the spending patterns of retired people and how it contributes to the economy, there's a net benefit. And there's not enough people that are stating that out there. So there's an education side to this that has to happen,
Mike.
First of all, I'd like to thank you very much, Darrell. I've heard you talk a number of times, and I'm really glad that you're on our side, because you really know a lot about pensions. Thank you very much.
Thank you.
Secondly, I thought most YUSA members would want to know on how much the increase was going to be to March 1st, 16th on those stepped-up increases. The average YUSA member, last time I checked, was band 8 or 9, and assuming that your YMPE of 2% each year, it would be about $1,150 in total to keep our pension going.
Right.
But really, I wanted to talk about the governance of the plan, if I could ask you a question on that, because we know going forward, you said that any plan amendments or any actuarial changes or something would have to be brought forward first, which is great because it hasn't been done up till now. I'd also want you to comment on the university being able to hire a new president and give him or her a full pension when they haven't actually worked a day yet. Is that possible? Maybe you don't have to answer that because it's too political, I don't know.
You're not running for political office, so it doesn't matter.
Well, we can debate about executive pay in a lot of areas and how inappropriate it is. I did the Indelex case, which went to the Supreme Court, which was a case of a company insolvent when it was a private equity firm that paid itself $111 million, but couldn't manage to pay $1.75 million to satisfy the deficit of their pension plan, and basically buried the company. What do you do with these things? I think there's two sides to your question. One is, in granting a full pension to the president, is it granted via this plan, or is it done outside of the plan? Because if it's done outside of the plan, it certainly has no impact on plan members directly. And as a line item, it probably doesn't have much of an impact operationally overall when you look at the total budget of the university. But of course, if you were looking at granting past years of service within the plan and not adequately funding it, there would be obviously an issue, and there may also be legal issues with that as well. But what you don't want to see is freebies being granted within a plan that you're paying your money into, obviously. Yeah, that's like, as I say, there would be legal restrictions in terms of
revenue
that.
will not allow you to go past, like to pick up past years now. We have a huge problem with that as well,
Right.
with the buyback.
But you can have reciprocal agreements, and you can have ways of granting recognition, and you have to obviously do that on a prudent basis in terms of how you value assets and administratively what the assumptions are that are being used. So you're quite correct. There's absolutely there are rules established under the Income Tax Act in terms of what you can or cannot do for past service. But from your question, I think it's something that's actually really outside of the pension plan and not relevant to the funding aspects of the pension plan itself.
But we could address it in the non-monetary issues.
Yeah, I mean, sure, of course. It can be addressed in non-monetary issues.
Yeah, Patrick will be here.
Yeah.
Hi, Patrick Legree. What I'm interested in is there been any number crunching done regarding employment issues in terms of job closures, layoffs, if we don't go forward with this? Rumors are flying around saying that 10 to 20% of the workforce would have to have job closures to pay if we don't go forward.
We haven't. I mean, that's sort of outside of our mandate. We're looking at the pension plan itself. But for example, on that 50% solvency reduction example, we still were looking at a 2% of budget operational impact if we weren't going to go into this. Well, if you have a 2% reduction in your budget, obviously you have to make adjustments somewhere as to what you're going to spend that on, whether that results in no new hiring or job reductions or ignoring infrastructure requirements, I don't know, because that's beyond our mandate. But there's an impact of not dealing with this issue.
Thank you.
I think you covered it. Any other questions? So we just want to thank everyone for coming. We do recognize how, as Darrell said earlier, weighty this subject matter is. Everything that's presented here is going to go up on our website. The recorded webcast will be available, I think, on Monday. And if you have any questions, please send them our way. I do want to thank Robert, Rosh, and Bert who are our technical people, along with Bob McKenzie. We're really grateful to you guys. We've never done a webcast. We've never done it in this forum, and we're really grateful that you were able to help us access as many members as possible, so thank you. And I want to thank everyone for coming out. I want to thank Julio, who's been the point person for YUSA on this matter. I'm really grateful to him, especially through my illness. And of course, Darrell Brown, who was unbelievable, a rock, instrumental. This is going to be, I think, the biggest issue unions are faced with over the next decade, guys. Unions are all facing this same problem. Certainly with YUSA, we are no different. We're not excluded. We're not unique. It's a big issue. We need to address it. There will be a vote, and we need to be educated on this. So please get engaged in this topic, find out more information about it, and come out to the polls and vote when we set it all up next week. So thank you for coming out, everyone. Appreciate it. Is that okay? Thank you so much. Couldn't have done it without you.